Hey, what's up everyone? This is the Smart Money Technician and welcome to today's video, Beginner's Guide to Sequential SMT. Okay, so now before I get into the video, make sure you like, you comment, and you subscribe to this channel because what I'm going to be discussing in this video is super powerful. And if you put the things that I tell you in this video, you're literally going to see a increase in your accuracy because many of you are trading SMT, many of you are trading sequential SMT, and you are trading it wrong. This is why you are losing many of your trades. And I'm going to show you the little things that you can incorporate that will drastically improve your accuracy in choosing the correct sequential SMT. So that is what this video is about. Sequential SMT is the most powerful thing. There is no move in this market that takes place that is algorithmic that does not occur without sequential SMT. Sequential SMT is always the high or the low of the week. You can go and check it for yourself. If a move happens without sequential SMT, it is most likely manual intervention. So if there's anything you really want to learn and if there's anything that you want to perfect, it is sequential SMT. If you're someone who already trades it, ask yourself, are you currently winning with sequential SMT? Okay, you're not winning. Then you need to watch this video multiple times because I'm telling you, you're literally going to see that these things that I'm going to discuss about sequential SMT, you are not incorporating them, hence why you are losing on it. So let's get into the video. Now, before we get into the actual lesson of this video, I just want to make a quick tutorial for those of you that are brand new. Now, if you are a quarterly theory veteran and you already know these things, feel free to skip ahead into the video when I get into the actual presentation. Alright, so currently I am on TradingView, right? And in order to trade sequential SMT, you need an indicator. It's free. You don't have to pay for it. It's called Day Quarterly Theory by 2 Degrees. You can search it, you can add it to your charts, and it's going to show up over here, right? So over here, as I click on the indicator, you can see that there are different quarters, right? The early quarter is more so if you're a position trader. The monthly quarters or the monthly cycle is more so for swing trader. The weekly cycle is more so for a short-term trader to sometimes day trader. Daily cycle is more for a day trader. The 90-minute cycle is for a day trader or even a scalper. And then the micro cycles is for if you are a scalper, right? So keep that in mind. Add this indicator because you cannot trade sequential SMT without it. Thank you. Alrighty, so on the indicator, I have selected the monthly cycle. And you view the monthly cycle through the lens of the 4-hour time frame. Now with the monthly cycle, what we do is that we take an entire month's worth of trading and we split it into 4. This gray box represents the first quarter or the first week of the month. This red box represents the second quarter or the second week of the month. This third box, the green box, represents the third quarter or the third week of the month, and the blue box represents the fourth quarter or the fourth week of the month. Now, as you progress, you will enter into a new month and it will continue going. Q1, Q2, Q3, Q4, Q1, Q2, Q3, Q4, every time you enter a new month. But once in a while, you will see that there is a blank box. We call this a blank week. Now, a blank week is basically the 13th week in the year. So if you count here from the start of the year, the first week, second week, third, fourth, 5th, 6th, 7th, 8th, 9th, 10th, 11th, 12th, the 13th week in the year is going to be a blank week. And as you go, you will see more blank weeks as you go. Every 13th week, you will get a blank week. A blank week, what you need to know about it is that it is low probability. You want to avoid these weeks because they will disrespect all analysis and they will make you feel confused and lose your confidence in trading. This is very low probability. During this time, I go on a vacation and I advise you to do the same. All right. So this is the monthly cycle and it is important that you view it through the 4-hour time frame. Alright, so on the indicator, I've selected the weekly cycle and you view it through the lens of the 1-hour time frame. Now, the weekly cycle, what we do is that we take an entire week's worth of trading and we split it into quarters, right? So Q1 is Monday, Q2 is Tuesday, Q3 is Wednesday, and Q4 is Thursday with the addition of Friday. Friday appears here blank, but keep in mind that it is not the same thing as a blank week for the monthly cycle. Friday can be treated the same way that the other quarters are treated, even though it is not a part of quarterly theory. So this is the weekly cycle. Alright, so I've selected the daily cycle and you view the daily cycle through the lens of the M15. Now the daily cycle is that we take an entire day's worth of trading and we split it into quarters, right? The first session, which is the Asia session, is Q1. Q2 is the London session, Q3 is the New York session, and Q4 is the afternoon or the PM session. This is the daily cycle, okay? Alright, so on the indicator, I've selected the 90-minute cycles and you view the 90-minute cycles through the lens of the M5 time frame, right? So basically, the 90-minute cycles is that we take a session in the day, for instance, the New York session, and we split it into quarters. So this is Q1 of the New York session, Q2 of the New York session, Q3 of the New York session, and Q4 of the New York session. You can do this with any session. For instance, this is the London sessions, Q1, Q2, Q3, and Q4. The same thing can be done with Asia, and the same thing is also done with the afternoon session, right? So you can see over there, right? Alright, so currently I am on the microcycles, right? And you view the microcycles through the lens of the 1 minute time frame. Basically, the microcycles is that you take a quarter of the 90-minute cycles and you also split that into quarters as well, right? So you have Q1, Q2, Q3, and Q4 of that 90-minute cycle, just viewed through the lens of the micro cycle, right? So don't let this confuse you. You're going to get everything and we're going to explain everything because each of these quarters are important, right? Alright, so what is sequential SMT or SSMT? It is a crack in correlation between correlated assets, where one asset trades through the highest high or the lowest low of the previous quarter, while the other correlated asset in the triad fails to trade through the highest high or the lowest low. SSMT time frame alignment. Now in the earlier tutorial, I did tell you the time frames that you view the different cycles on, but you can screenshot this, right? So that you can ensure that you are viewing your sequential SMT on the correct time frame in respect to the cycle that you are viewing that sequential SMT on. If you don't do this, you are going to get incorrect information, which is not good. Thank you. Alright, so let's get into an example of sequential SMT. So over here we have the index futures triad. We have S&P 500 on the left, NASDAQ in the middle, and Dow Jones on the right. So we are watching the weekly cycle, right? So during the current quarter, which was Q2 at this time, we failed to take out the low of the previous quarter, while in NASDAQ we took out the lowest low of the previous quarter. While also in Dow Jones, we failed to take out the lowest low of the previous quarter. All right. So this is sequential SMT, right? In a nutshell, it can happen on any cycle. It doesn't only have to be the weekly cycle. It can happen on any cycle. Okay. All right. So factors that make a sequential SMT low probability: unsymmetrically timed highs or lows for the previous quarter. This simply means that the previous quarter's high or low in which you are gauging your sequential SMT does not form at the same time in the different assets. Sequential SMT that forms in Q1 of its lower time frame cycle. So for instance, if you are trading the weekly cycle, what would be the lower time frame cycle of the weekly cycle? That would be the daily cycle. So for instance, if you get a weekly cycle sequential SMT during Q1 of the daily cycle, which is the Asia session, that is generally low probability, right? Sequential SMT between Q1 and Q2 of the 90-minute cycle during the New York session. This specific sequential SMT is generally low probability, as I'm sure many of you during the New York session, when you saw an SMT between Q1 and Q2, it usually loses. Sequential SMT with the wicks, but not with the closes, highest or lowest of the previous quarter. We're going to give an example on this to illustrate this. Sequential SMT not synced to premium and discount. We will also give an example on this to illustrate this. So all in all, low probability sequential SMT need an additional crack in correlation to confirm them. It will not work without an additional crack in correlation. Alright, so factors that make a sequential SMT high probability. Symmetrically timed sequential SMT. Basically what this means is that the previous quarter in which you are gauging your sequential SMT, that high or low, basically forms at the exact same time in all three assets. Sequential SMT with the wicks, and the closes of the candle, highest or lowest. We're also going to give an example to illustrate this. And then sequential SMT that is in the direction of your draw on liquidity. Basically, you have a higher time frame draw on liquidity, a bias, a general direction that you expect price to go into. And then you see a sequential SMT pointing in that direction that is generally high probability. All right, so example number 1. Right, so you can see that we're on the daily cycle, and between Q2 and Q3, or between London and New York, we got a SMT where this asset came and took out the low of the previous quarter, while in another asset, it failed to take out that low. Right, the reason why this SMT initially was low probability is because when you see sequential SMT, the asset that takes out the previous low of the previous quarter, it also needs to close during that quarter below the lowest close of the previous quarter. So if you look closely over there, this bearish candle closes there, and that was the lowest point that price closed during Q2. Now during Q3, we just take out the low, but we do not close below that lowest close, right? The asset that fails to take out the low must also close above the lowest close of the previous quarter, which it does. But because this asset takes out the low but does not close below that lowest close, this made the sequential SMT low probability, and we need an additional cracking correlation to confirm a low probability sequential SMT, which we get a precision swing point. So you can see over here, this over here is a bearish candle, but that same candle in the other asset was a bullish candle, right? So you can see that it confirmed this low probability sequential SMT, hence the reason why price traded higher. All right, so example number 2. So initially, we have a sequential SMT, and we can see that the lows of the previous quarter are symmetrically timed, meaning that they form at the exact same time. Over here, it forms on 7 a.m., and in the other asset, it also forms at 7 a.m. And the asset that takes out the low of the previous quarter also closed below the lowest close of that previous quarter, while the asset that failed to take out the low also failed to close below the lowest close of the previous quarter. In textbook definition, this would be a high probability sequential SMT. However, the reason why this sequential SMT would have been considered a low probability sequential SMT is because what happened is that it formed during Q1 and Q2 of the New York sessions 90-minute cycle. This is very specific to this sessions cycle, okay? So Q1 and Q2 SMT of the New York sessions 90-minute cycle is generally low probability, because what happens is that in Q3, what happens is that it can reverse and take out that low. And in order for you to know that Q3 is going to expand, you need a crack in correlation in Q3 to confirm this. So over here, if you look very closely, we have a bullish candle right here, and then we have a bearish candle right there. And that is what confirmed it. But a further confirmation, because a precision swing point can just randomly form and it can go any direction, right? So in order to know the true direction of the precision swing point that is forming here on the lower time frame, right? If you look closely, we have this particular pattern, right? So this pattern is when you see unsymmetrical lows. So over here you have a higher low while there you have a lower low. During Q3 of the 90-minute cycle on the 1-minute time frame, price took out that low in both assets, right, and formed a precision swing point. This particular pattern is a pattern that is not occur frequently, right, but it is a pattern that is a reversal sequence. So when this pattern formed, right, it indicated bullishness, confirming what had happened over here, right, meaning that Q3 will expand and it is not going to reverse, taking out this low probability sequential SMT. All right, so example number 3. So you can see that we have a sequential SMT as during Q3 of the 90-minute cycle, we take out the previous quarter's low, while in the other assets, we fail to do so. But if you look very carefully, the low of the previous quarter is not symmetrical. They form at different times. Over here, it forms at this time, while in the other asset, it forms at that time, making it low probability. If you also look very carefully, the assets that are failing to take out the previous quarter's low close below the lowest close. They're not supposed to do that. They're supposed to close above it. So that again makes it low probability. But then what then confirms it is that a precision swing point forms. So in ES and NQ, it was a bullish candle over there, while in Dow Jones it was a bearish candle, and this is what caused price to eventually trade higher, right? Now I want to note something else in the chart. Can you see that the low of the previous quarter in Nasdaq is a bearish candle, while that same candle in ES is a bullish candle? Whenever you have a precision swing point being the low of the previous quarter in one of the assets, there is a probability that the asset that takes out the low of the previous quarter will come back one more time to stab through the low that it made when it made the SMT initially. So I'm just giving you every little signature that price gives so that you can be able to be aware of the things that sequential SMT can do. Thank you. All right, so example number 4. On the daily cycle, we had a sequential SMT, right? If you look very closely at this sequential SMT, the lows are not symmetrical, unsymmetrically timed lows, right? They don't form at the same time, making it low probability. At the same time, if you look at the asset making the failure swing, the asset that fails to take out the low of the previous quarter, during Q3, it closed below the lowest close of the previous quarter, which is not supposed to be. This is another signature making it low probability. So when we then get the actual sequential SMT taking place, if you look very closely at the candle, the next candle, this is the candle, this bearish candle is what causes the sequential SMT. Then the next candle then takes out the low of that candle. It also does the same thing in Nasdaq as well, but in Dow Jones, it fails to do that. This is another crack in correlation, which then confirms it is not too strong of a crack in correlation, but it does eventually cause price to bounce, especially in the assets that were making the turtle soup price eventually traded higher. So this was what confirmed the sequential SMT. All right, so example number 5. In example number 5, we have on the weekly cycle a sequential SMT between Thursday and Friday, where Friday takes out the high over here in Dow Jones, and in the other assets it fails to do so. But if you look very closely, the high of the previous quarter is not symmetrical. It is unsymmetrically timed. At the same time, the asset taking out the high of the previous quarter does not close above the highest close of the previous quarter, another signature showing that it is low probability. So we need an additional crack in correlation to confirm this. While this was happening, if you go into the lower time frame, we were also getting a daily cycle sequential SMT, right? So over here, we take out the high of the London session. In the other asset here, we failed to take it out, right? But if you look very closely, the high of the London session was also unsymmetrical. So it was not symmetrically timed, another low probability sequential SMT. And we cannot use a low probability sequential SMT to confirm another low probability sequential SMT. So we need an additional crack in correlation, right? At the same time, this asset also did not close above the highest close, again, low probability. So what then happened on the M5 time frame is that we got an SMT, but this SMT was not sequential. It was between Q1 and Q3, where we failed to take out the high of Q1, but we do take out the high of Q1, right? But if you look very closely, it is also an unsymmetrically timed high. So what then happens is that a precision swing point then forms, confirming this non-sequential SMT, right? And then it is what causes price to trade lower. So a non-sequential SMT that is valid with this precision swing point that forms can confirm all this mess over here. So we have this SMT here, low probability. We have this SMT over here, low probability. And we have this SMT over here that is confirmed with a precision swing point, making this one valid, confirming everything. All right, so example number 6. So in this example, we can see that we are getting a sequential SMT between the London and the New York session on the daily cycle, right? Now, the reason why this SMT is not a high probability one is because when Dow Jones comes and takes out the low of the previous quarter, number one, it also does not close below the lowest close. But more importantly, look where ES and NQ are trading. They're all the way in premium while this one is in discount, meaning that they are decoupled, meaning this one is doing its own thing and you can get deceived by this SMT. Let's look at the result of this SMT. Dow Jones eventually does trade up, but if you decided to trade ES or NQ, you would have lost, as another SMT formed which causes them to trade lower, right? So this is a low probability sequential SMT. It needs to be in sync with premium and discount. All right, example number 7. And as you can see, we have a sequential SMT on the daily cycle between London and New York session. However, you can obviously see that the high of the previous quarter is unsymmetrically timed highs, making it a low probability sequential SMT. So we need another cracking correlation to confirm it, right? So what then happened is that we then got a 90-minute cycle sequential SMT, right? Where this asset took out the high of the previous quarter during Q3, right? While this asset failed to do so, right? However, if you look at the high of Q2, which is the previous quarter, it is also unsymmetrically timed. It is another low probability sequential SMT. However, if you look very closely during this time where price takes out the high of Q2, these were the candles over here. This candle takes out the high of that candle while this one failed to do so. This little cracking correlation confirmed this low probability second stage sequential SMT, which is what then caused price to trade lower. As you can see immediately when it happened, it caused price to go lower because price had already met everything it needed for it to then trade lower. Alright, example 8, you can see that we have a sequential SMT on the daily cycle between the London and the New York session where Dow Jones takes out the low of the previous quarter while ES and NQ failed to take out the low of the previous quarter. And you can see that the low of the previous quarter is an unsymmetrically timed low. It is low probability. At the same time, Dow Jones, which is the asset taking out the previous quarter's low, does not close below the lowest close of the previous quarter. Another thing making it low probability. So if we look much more closer on the lower time frame, which was the micro cycles, what happened is that during Q3 of the New York session, we had these unsymmetrical lows, and then price took out that unsymmetrical low, that same reversal sequence that I showed you earlier on, forming a precision swing point, which is what then confirmed this sequential SMT, and which is what then caused price to eventually go higher. Okay. Alright, so example number 9. Now in this example, I want to show you when sequential SMT fails. So remember I said that when the SMT forms during Q1 of its lower time frame cycle. So over here, we have a sequential SMT between Monday and Tuesday on the weekly cycle. However, this sequential SMT formed during the Asia session, which is Q1 of its lower time frame cycle, which was the daily cycle, right? When this kind of sequential SMT happens, you can expect that during the New York session, if London expands in the direction of the sequential SMT, during the New York session, you are going to get an unprompted reversal, meaning that a reversal that you do not expect will suddenly take place, taking out the highs of that sequential SMT. So you can see over here, we have just a random SMT. It is not even a sequential SMT, and it literally causes price to reverse on this sequential SMT, trading higher. So this is why this sequential SMT was low probability. And anytime I see low probability sequential SMT where it formed during Q1 of its lower time frame cycle, sometimes I will look for a reason to go against that sequential SMT. And finally, example number 10, another example showing you when the sequential SMT is likely to fail. So over here we have that classic Q1, Q2 New York session 90-minute cycle sequential SMT that is a low probability sequential SMT. Now, during Q3, you would need a confirmation to confirm price going lower. However, we did not get that. In fact, we formed the opposite cracking correlation this time on the micro cycles if you zoom in very closely, right? So anytime I have this kind of SMT and I see a SMT in the opposite direction, even on a micro cycle, because the microcycle is much more smaller than the 90-minute cycle, so you would expect that this one would be stronger and cause price to go lower and this one to not be respected. But because this one is a low probability sequential SMT, this one over here is going to take more precedence, meaning that this one will be weighted more, which then is the reason why price then reverse, taking out the highs in this asset. So you can frame a bullish bias against this SMT, knowing that it is a low probability sequential SMT. All right, thank you for watching the video. Make sure you guys like, you comment, and you subscribe to the channel. If you put these things into practice, folks, you are going to notice that you are not going to choose the sequential SMTs that are going to fail, because you are going to know when to wait for an additional cracking correlation, or if that additional cracking correlation does not form, you know that It is a low probability sequential SMT and you should avoid it. You will also know when to trade in the opposite direction, which I showed you. This is very powerful, folks. Put these things into practice. Go and back test, because trust me, there are different ways it can happen and I could not possibly cover every single thing in this video. But put it into practice and you will see a fruitful outcome. Make sure you like, you comment, and you subscribe. Thank you.